Hello and welcome your tune into this special YouTube edition for Mutual Fund Corner. I'm Sonal Bhutra, and today we are going to be discussing everything about debt funds, especially in the light of a possibility of a pause in rate hikes from here on. We have with us an expert, Gaurab, who's the head of sales and marketing at Bandhan AMC Limited, is joining us now. Mr. Parija, good afternoon. Thank you so much for joining us. We did see the RBI pausing rate hikes at least in April. We do have the next one coming up. Just for the understanding of our viewers, is it a good time to look at debt funds when we are looking at a pause in rate hike cycle? How does it work?
Thanks, Sonal. Thanks firstly for having me on the show. Over the last so many years I've been in the industry, a question which has always been very perplexing is what is a good time to enter into any asset classes? Sadly, over the last so many years, there must be very few occasions where a particular asset class is like a slam dunk, where you pretty much have to buy it because it's so cheap. Quite clearly, while the answer seems a little cliche or boring, one continues to believe that you need to buy into an asset class for the underlying need of your investment. So I might be the most risk taker in terms of investments, but I clearly believe if I have a liability coming up over the next month, I need to be in very short-dated fixed income, if not bank deposits. Now, moving on to your question very specifically on whether it's a great time to get into debt funds or not. Firstly, please tie your investments to your underlying need. There is never a good or a bad time. Quite clearly, given all that is happening in the fixed income market, both globally and India, we believe that the rate hike cycle for India seems to be pretty much over. We think it's going to be higher for longer. And given the context that the yield curve is fairly flat, we believe there's an opportunity to look at funds which invest in the 3 to 6 year government securities market.
Okay, all right. So that's your take on debt funds. But generally, there has been this big debate after the change in tax regime where the indexation benefit was taken away from debt funds. After that, the debate has been, is FD better or a debt fund? What is your take?
Again, I don't think there is one straight answer of saying this is better than the other. Each has its own pluses and minuses. Having said that, there's been a lot of noise post the debt taxation change which happened late March. But to put things straight, let me take you through some points as to why we think fixed income funds still are something you need to look at. Firstly, fixed income mutual funds are tax neutral now. They're not tax inferior. They had a tax advantage. The tax advantage is gone, but they're tax neutral. Secondly, do remember fixed income mutual funds give you the benefit of a deferred taxation as against an accrued interest taxation which comes in other traditional fixed deposits or fixed income instruments. Third, you still have the benefit of offsetting your capital gains at some stage against potential losses you have. Fourth, while it's very easy to say, look, given that the tax advantage is not there, let me go and handpick and cherry pick some bonds. To execute a buying of a bond is very difficult. Two, you might have the ability to buy them, but when you go to dispose, you will have to pay your pound of flesh because liquidity is very tight across the bond markets. Fifth, do remember, even in a fixed income instrument traditional, if you want to buy a paper every single day, you open multiple folios. Unlike that, in a mutual fund, you can keep buying into the same folio. So if I have to take you and run through all of these points, I still believe there is a huge place for a fixed income mutual fund, notwithstanding all the noise the market seems to be making. And just to quickly corroborate that, we've actually looked at flows in the Indian mutual fund industry post April 2023 and compared that to the flows in what happened in April 22. Surprisingly, gross flows across mutual fund industry in fixed income is pretty much at the same levels. So I would sincerely urge investors to look beyond the noise, look at what their underlying needs are, look at the benefits still of investing in a fixed income mutual fund, and then take a call. Having said that, let me reiterate, there is nothing called that we are better than the other instrument. It all depends on what type of risk profile you have, what is the underlying need, and all of those other questions which you need to ask.
Of course, that point is well taken, and that's an excellent 5-point explainer as to what works for debt funds. And most important, they're tax neutral now, not tax inferior, because they did see an advantage earlier. We take that point, Mr. Parija. But generally, what I wanted to understand is when it comes to mutual funds, people usually look at equity classes. There was a recent report by CAMS as well which suggested debt is still a smaller part of the overall portfolio exposure. What has been your take? How has debt allocation been in last couple of years? What is the exposure right now in the investor community?
A very valid point and an observation. I think if you have to look at the split of fixed income mutual funds in the industry, it's still dominated by corporate investors. The HNI segment as classified by the regulator comes second, and the retail investors, so as to speak, again by definition of the regulator, is a very small portion. Having said that, over the years, the industry has made a lot of progress, a lot of initiatives to start pushing this asset class, and quite clearly over the last 4-5 years, people are looking at it in a far more open manner. Having said that, one of the things I've always talked to clients and distribution partners is saying that if we all believe that the key to creating asset or wealth is asset allocation, it's very interesting that we tend to look at equities as a core component of asset allocation and ignore fixed income as being a very integral part. Because do remember, each asset class has its own merits. We think equity or fixed income funds which play credit are pro-cyclical, and your traditional fixed income funds are counter-cyclical. So you need to have both asset classes. Like I said in my earlier comment, we believe there is a merit and there is a place for fixed income funds in every client's portfolio, depending on your risk profile and the underlying investment need. And hence, that's how you'll have to bring about the asset allocation across equity and fixed income.
Okay, so you actually answered my next question already. I was going to ask you, what should an ideal mix be? Say a person is in low risk, medium risk to high risk. How much should the debt proportion be in all these cases?
Sonal, I would love to have given you one straight-jacketed answer. My answer, again, at the cost of repetition, is it's very difficult for me to give one formula answer that, oh, if you are in the 30s age bracket, you should be this. Obviously, there is this whole asset allocation table which says 100 minus age should be in equity and all of that. Having said that, it's absolutely critical that people need to define their end goal. It's like saying, I want to move from point A to B. But if I don't know where your point B is, for me to tell you which mode of transport to take is going to be a very, very academic answer. In the same way, even if you are in the 30s and if you have a home loan coming up or a big liability coming up over the next 6 months, and you might be the most aggressive investor ever on earth, you still have to go back and put money in an instrument which is low volatility, which is like pretty much fixed income. So there sadly is no straight answer. The bottom line is, if your goals are more than 5 to 10 years, it is good to take a larger allocation in equity. If your goals are lesser than that, you need to start investing more in fixed income. If your goals are less than 6 months, I would pretty much restrict myself to, if I have to look at mutual fund categories, liquid and overnight. Similarly, if you are about to retire, your investment allocation between equity and debt has to move a little bit more towards debt than equity.
Okay, we take your point, Mr. Parija. It was a very enlightening conversation. Thank you so much for joining us and making sense of this fixed income debt category for us and for our viewers as well. Hoping to speak to you very soon. Thanks a lot for joining us today.
Thank you, Sonal. Always a pleasure talking to you. Bye.
Okay, with that, we'll take your leave on this special edition. Stay tuned to CNBC-TV18 for more updates.